In this video, we're digging into the biggest mistakes that people make when refinancing their car loans and how to avoid them. What's going on, everyone? My name is Eric Hunsker, and on this channel, we cut through the fluff to help you manage your money intelligently. If you're considering refinancing to lower your payments or interest rate, this video will help you steer clear of costly missteps. Why refinance a car loan at all? So before we jump into the mistakes, let's briefly discuss why people refinance. Car loans are amortized, meaning you pay more interest up front and more principal toward the end of the term. Refinancing can help you secure a lower interest rate if market rates have dropped or your credit score has improved since you bought the car. Reduce your monthly payment by extending the loan term. This frees up cash flow but may cost more in the long run. Remove a cosigner if you originally needed one but no longer do. Move to a different lender for better customer service or terms. Sounds great, right? It can be, but only if you avoid the following mistakes. Mistake 1, focusing only on the monthly payment. The most common mistake is obsessing over the monthly payment and ignoring the total cost of the loan. Lowering your payment by extending the term may relieve monthly pressure, but increase the total interest that you pay over the life of the loan. For example, refinancing a 3-year loan into a 6-year loan could drop your payment from $450 to $250, but you might end up paying thousands more in interest because you're stretching payments over a longer period. Avoid it. When evaluating a refinance offer, always look at the annual percentage rate, the APR, the total interest cost, and the new term. Use an online loan calculator to compare the cost of your current loan with the proposed refinance. If the total interest savings are minor or negative, think twice about extending the term just to lower the payment. Consider making extra principal payments instead. Mistake 2, refinancing without checking your credit. Your credit score plays a big role in the interest rate that you'll qualify for. People often apply for a refinance without first reviewing their credit scores and reports. If your credit has improved since you took out the original loan, you may qualify for a lower rate. If your credit has taken a hit, then you might actually get a worse rate or be denied altogether. Avoid it. Pull your credit reports from the major bureaus and check your scores. Fix any errors. Incorrect late payments or fraudulent accounts can hurt your score. If your credit is borderline, consider waiting a few months and making on-time payments to boost your score before refinancing. A difference of just a few percentage points in interest can save hundreds or even thousands over the life of the loan. Mistake 3, not shopping around. Another big mistake is accepting the first offer you see. Lenders, whether banks, credit unions, or online finance companies, set their own rates and fees. Some offer lower rates for borrowers with excellent credit, while others target those with fair credit but charge higher fees. If you only request a quote from your current lender, you might miss out on a better deal elsewhere. So avoid it. Shop around. Get pre-qualified or obtain quotes from multiple lenders, including local credit unions. Credit unions often have competitive rates and lower fees because they're member-owned. Online marketplaces can show multiple offers at once. So compare interest rates, fees, and terms. Even a 0.5% difference in interest rate can make a noticeable difference in your monthly payment and total cost. Mistake 4. Ignoring fees and prepayment penalties. Refinancing isn't free. Some lenders charge origination or application fees, title transfer fees, or other closing costs. Additionally, your original loan may have a prepayment penalty, a fee for paying off the loan early. If you don't factor these costs into your calculations, the refinance might not save you money. So avoid it. Ask potential lenders to disclose all fees and incorporate them into your comparison. Read your current loan agreement to see if there's a prepayment penalty and how much it is. If the penalty and new fees outweigh the interest savings, refinancing might not be worthwhile. Also look out for add-ons, like extended warranties or credit insurance that lenders may try to sell you. These extras can inflate your loan amount without providing much value. Mistake 5, refinancing a car that's underwater or too old. Underwater means you owe more on your car than it's worth. Lenders are less willing to refinance an underwater loan because the car is collateral for the debt. Similarly, refinancing a car that's too old or has very high mileage can be difficult because lenders worry about its resale value. Even if you manage to refinance, your interest rate could be much higher to compensate for the risk. So avoid it. Before applying, check your car's current market value using reputable valuation guides. If your loan balance is near or above the car's value, refinancing probably isn't a good option. Instead, focus on paying down the principal or consider selling the car and buying a more affordable vehicle. Also, many lenders have restrictions on vehicle age and mileage. Often 10 years or older or over 100,000 miles may not qualify for refinancing. So don't waste time applying if your car falls into this category. Mistake 6, waiting too long to refinance. Car loans are front-loaded with interest, meaning you pay most of the interest in the early months of the loan. Waiting until you're halfway or more through the term significantly reduces the potential savings from refinancing. By that point, you've already paid a large portion of the interest, and extending the loan could reset the amortization schedule, causing you to pay additional interest on a smaller remaining balance. So avoid it. Refinancing is most beneficial in the first half of your loan term, ideally within the first year. So wait at least 60 to 90 days after purchasing your car to allow the title to transfer and your credit to recover from the initial hard inquiry. Then, if rates have improved or your credit has increased, compare refinance offers. If you're already close to paying off the loan, it might be better to stick with it and avoid resetting the interest clock. Mistake 7, forgetting to keep up with payments during the process. When people refinance, they sometimes assume they can skip a payment or two while the process is underway. Unfortunately, missing or delaying a payment on your existing loan, even if you're about to refinance it, can lower your credit score and jeopardize your approval. Some lenders allow a short gap, but you shouldn't count on it unless you have a written confirmation. Avoid it. Continue making all scheduled payments on your current loan until the refinance is complete and your existing lender confirms that the balance has been paid off. If a payment is due during the transition period, make it. Overpaying slightly is better than risking a late mark on your credit report. Any overpayment will be refunded once the old loan is closed. Mistake 8, falling for scams or predatory lenders. Unfortunately, the refinance space attracts unscrupulous actors. Predatory lenders lure borrowers with promises of low rates and easy approvals. Then they add in tons of hidden fees, exorbitant interest rates after an introductory period, or prepayment penalties that trap you in high-cost loans. Others may pressure you to roll negative equity from your previous loan into a new one, leaving you deeper in debt. So avoid it. Work with reputable lenders and check their reviews. Be wary of unsolicited calls or emails offering guaranteed approval or demanding upfront fees. Read all paperwork carefully and don't sign anything that you don't understand. If a deal seems too good to be true, it probably is. When in doubt, consult with a trusted financial advisor or credit union. Mistake 9, forgetting to remove a cosigner. If you originally needed a cosigner for your car loan, refinancing is a chance to remove them if your credit has improved. Forgetting to remove a cosigner ties them to your debt and affects their credit utilization, even if you make payments on time. In the worst case, they could be on the hook if you stop paying. So avoid it. When applying for a refinance, let the lender know you want to remove the cosigner. Provide proof of improved credit and income. Once a new loan is approved, confirm that the old loan has been paid off and the cosigner is released. Inform the cosigner so that they can verify the release on their credit reports. Mistake 10, overlooking gap insurance and extended warranties. When you first purchased your car, you might have rolled gap insurance or an extended warranty into your loan. If you refinance and reduce the loan balance, then you might not need gap insurance anymore because the risk of being underwater is lower. Conversely, the new lender might require gap coverage if you still owe a significant amount relative to the car's value. So avoid it. Review any add-ons in your current loan. If you still need gap coverage, compare separate gap policies instead of financing it through a new loan where you'll pay interest on it. Similarly, consider whether an extended warranty is still worth the cost, especially if it's near expiration or the car's reliability has proven solid. So refinancing your car loan is a decision that requires careful thought. When done correctly, it can lower your interest rate, reduce your monthly payment, and save you money. But when mismanaged, it can extend your debt, increase your total costs, and even put your credit at risk. The biggest mistakes people make: focusing only on the monthly payment, neglecting their credit, failing to shop around, ignoring fees and penalties, refinancing underwater or aged vehicles, waiting too long, missing payments, falling for scams, forgetting cosigners, and overlooking gap insurance are all avoidable with a little preparation. So take the time to understand your current loan, improve your credit, and shop wisely. Ask questions, read the fine print, and don't be afraid to walk away if an offer doesn't truly benefit you. By avoiding the pitfalls we've discussed, you can make a smart decision that aligns with your financial goals. So if you want to get started with any resources that we recommend when it comes to this sort of thing, you'll find links for them down in the description below. Some of these are affiliate links, which means we earn a small commission if you decide to use them at no extra cost to you. This really helps support the channel and lets us keep making simple, beginner-friendly videos to help you take control of your money. So if you use them, thank you. Seriously. And if this video helped you out, don't forget to like, subscribe, and hit that notification bell so you never miss a new video. Here on Your Money Friend, we talk about saving, banking, and investing basics, and all the little money decisions that make life easier without all the confusing jargon. So thanks for watching, and we'll see you in the next video.